Hello, everyone. Welcome to today's session on monetary policy. In this presentation, we will understand what monetary policy is, its objectives, types, instruments, advantages, and limitations. Monetary policy refers to the actions taken by a central bank to regulate money supply, control credit conditions, and influence interest rates in the economy. The primary aim is to maintain economic stability by controlling inflation and supporting sustainable growth. The most important objective of monetary policy is price stability, which means keeping inflation under control. Along with this, central banks aim to promote economic growth, ensure employment generation, maintain financial stability, and manage exchange rate fluctuations. There are two main types of monetary policy. Expansionary policy is used during recession or slowdown. It lowers interest rates and increases money supply to boost borrowing and spending. Contractionary policy is used when inflation is high. It raises interest rates and reduces liquidity to slow down excessive demand. The repo rate is the rate at which the RBI lends money to commercial banks. If repo increases, loans become costlier. If repo decreases, loans become cheaper. The reverse repo rate is the rate at which banks park funds with RBI. CRR or cash reserve ratio is the percentage of deposits banks must keep with RBI. SLR or statutory liquidity ratio is the percentage banks must maintain in liquid assets like government securities. If CRR or SLR increases, banks have less money to lend, reducing liquidity. Open market operations refer to RBI buying or selling government securities in the open market. When RBI buys securities, money flows into the banking system, increasing liquidity. When it sells securities, liquidity reduces. In India, monetary policy is formulated by the Reserve Bank of India through the Monetary Policy Committee. The MPC has 6 members and meets at least 4 times a year. Monetary policy has several advantages. It can be implemented quickly and is managed independently from political pressure. It is very effective in controlling inflation. However, it also has limitations, such as long time lags, limited effectiveness during deep recessions, and conflicts between growth and inflation objectives. Monetary policy directly affects banks by influencing their lending and deposit rates. This impacts borrowing, spending, and investment in the economy. Ultimately, monetary policy aims to balance inflation and economic growth to ensure long term economic stability. Thanks for watching. Keep learning and keep growing.